Welcome everyone to Show Me the Money, how owners actually get paid in an exit. Most owners don't actually understand how they get paid when they sell, and that's exactly why so many walk away with a smaller check than expected. Today we're fixing that. I'm joined by Jeff Jones and Eddie Clay from Growthink Capital, and we're going to break down the real mechanics behind payouts and deal structures. The truth about how money actually moves in an exit. And it doesn't matter if you're selling now, in 5 years, or you just want options. The rules are the same. If you don't understand them, you're the one who pays for it. We'll be discussing cash versus paper, earnouts that actually pay, when to roll equity, how to protect yourself from seller notes and holdbacks, and the psychology buyers use to shape deals. Let's get into it and make sure you know where your real money is made.
I think the important part here is for everybody to understand that a majority of the transactions we see these days include structure, right? It's not, hey, my business is worth 25 million. I'm going to get 25 million at close. That's normally not how it works anymore. There's some exceptions to the rule, and we've seen those recently. However, you need to be prepared for this, and majority of those deals, that's how it happens. And so when we talk structure, we think cash plus equity considerations plus earnouts or seller's notes or different kinds of holdbacks. And we'll go into these specific elements of structure. And I'm sure most of you have heard of these things or experienced them directly. But what you need to understand is in M&A, in potential exit when you're selling your company, price and payout are not the same. What matters is how much and when and under what conditions you actually receive the money, right? So, there's a few points here to consider where enterprise value of your business does not necessarily equal net proceeds, right? Enterprise value is the headline number. Net proceeds reflect fees, taxes, working capital adjustments, debt payoffs, escrows, contingency payments. And net payout can be heavily influenced by structure. And so we'll talk about those things as well. But timing is always key when you consider triggering of these events, right? Cash at close is the only guaranteed value. Everything else is kind of risk adjusted when you think about how buyers will structure deals. And so structure will also influence timing of payouts and incentives and all these things that we'll get into. And then structure as a risk allocation tool. So the buyers use structure to reconcile these valuation gaps, right? They de-risk the business growth and try to align incentives with the seller. That way, everyone's kind of working towards that enterprise value that was initially agreed to. But as a seller, you should always be evaluating the offers using your risk-weighted kind of scenarios, not just enterprise value, but what's important to me in terms of long-term upside, partnership, synergies, things of that nature. So your priorities should be all of the above, right? Liquidity, tax efficiency, risk tolerance, future involvement in the business, and how that impacts structure. It's not just always about the highest valuation. So wanted to set those kind of foundational ground rules here as we get into it. And we'll go into kind of the specifics with each slide. The core concept here is paper is not equal to cash, right? There's a difference. And if valuation, well, I should say, if payout doesn't align with your goals, and the valuation really doesn't matter. So cash at close equals certainty, right? It's paid immediately. It's the least risky of the different parts of structure, highest tax clarity, right? That you probably get as a seller with that bucket. Sometimes reducing enterprise value to get more cash is a consideration. And then just general paper consideration around what equity notes, rights are, earnouts are for you as a seller. There is, thank you, impact on taxes. So, an equity roll, often you can defer taxes. Earnouts, it really depends on structure. It could be taxed differently depending on that. And so, a deal with more cash can actually produce higher after-tax proceeds than a deal with more paper. It just really depends. And then something we always tell our clients when we're considering structure and how that works is the actual paper value is only as strong as the buyer's future health, really, and the business's future health, right? What is going to happen to the company going forward after you exit? or actually the transaction takes place. And so, the common mistakes here, I think sellers can sometimes overvalue paper when buyer actually values it at a discount. Um, and it's something to consider when looking at your deal leading into a potential exit strategy of how that structure will impact it overall. And again, being prepared and having a plan of what is realistic and what is something that you will entertain or not is critical to the process. Let's jump into kind of that first paper bucket of earnouts. Again, earnouts really bridge valuation gaps, but oftentimes these earnouts are not met for a variety of reasons. So, it's something you really have to consider. When earnouts are good, well, everything is going to be based on performance metrics. So, if I'm a seller, I see an earnout scenario where over the next 2 to 3 years, if we hit specific milestones, let's call it EBITDA metrics or revenue metrics or something of that nature, then there's a portion of the payout or enterprise value that I would receive, right? But as a seller, you have to have confidence that that's going to happen. But if there is upside and you do what you say you're going to do alongside your new partner, which is the buyer, then this could be very lucrative, right? Another reasons why earnouts might fail: vague metrics, unrealistic targets, loss of control going forward, things of that nature. So, I think too often, sometimes too, sellers might just accept earnouts to get a deal done, but you really got to consider what that entails. So, think about those achievable metrics, keep them simple, try to keep the duration short, right? Always consider seller influence, because once someone acquires the business, they kind of have control over what you're going to do in terms of growth, expenses, just general control over governance or people. And that might change your actual metrics of the earnout, right, as you go forward. So all these things you have to consider. And we kind of call that doing your own reverse due diligence in the process to understand what the buyer's intentions are for the business and yourself. So you always want to protect yourself and to be able to negotiate these terms. And by the way, this is oftentimes highly negotiated point in our deal making process. So understand what kind of support the buyer provides. Will they alter the business going forward? Can they manipulate the financial standing in the business, which may mess with one of your metrics or triggers, such as EBITDA, right? So not having control of those things is something you have to really consider. And so one huge takeaway, if you take one thing away from this call today, that every time we get into consideration between buyer and seller, and we are in the middle of that, right? When the buyer is looking at financials at the early onset of the conversation, they're looking at historical numbers, they're looking at forecasts, right? When the seller wants to send, when you want to send a forecast that really demonstrates big growth of the business because you're trying to get credit in terms of enterprise value in today's terms, that doesn't always benefit you in an earnout, right? So if you're trying to overshoot and get very aggressive in your forecast, for example, when the buyer sees those forecasts, they will use that to their advantage and peg that earnout based on that forecast, right? So we don't want to be unrealistic, right? If you've been growing 10, 20% year over year, fantastic. Let's keep that trajectory because it's a realistic hit. But if all of a sudden we're trying to get credit for growth and we're showing a buyer 50% year over year to get them excited, they're going to hold you to it, right? And so to mitigate that risk, they may give you some credit for it, but they're usually going to bake in an earnout to say, prove it, and then you get paid. So something we always see. We never, with the clients, whatever that buyer sees first, sometimes they hold us to it. So be very careful when you're thinking through future growth as it relates to earnout scenarios, because oftentimes we're going to see this mixed into the deal. Another big point here in terms of equity.
Absolutely. Thanks, Jeff. Equity rolls, we're not talking about baking here. We're talking about basically a reinvestment. For people who haven't heard rolls, it does sound very weird to talk about that in the context of mergers and acquisitions, right? But this is another way to keep chips on the table when you do a deal so that you can capture upside. If you stay on and continue running the company, for example, buyers will have interests aligned with them because they're not, in most cases, going to run the company unless you sell to an unbacked strategic buyer. Like, for example, private equity, this is very common. structure, because what they want to do, private equity, is they're backing the existing management team. Ideally, they're not bringing anyone in to run the company. They don't run the company day to day at all. They want to back what's working. And so they are not they want the CEO and the management team that's running the business to be fully aligned incentive-wise with the buyer, meaning that they want to grow as smartly and quickly as possible, responsibly, within the next 3 to 5 years. And so the equity role is a key component of those incentives, because, for example, the CEO ideally will own at least 20% of the company post-transaction of selling initially, while they're still running the company. That's the minimum that private equity would want to see to have the interests fully aligned, right? It's also a benefit for the CEO, because guess what? If the seller, the CEO, let's say, is very enthusiastic about the future growth of the business, then it's in his or her best interest to, in theory, retain as much equity post-transaction as they can in order to capture the upside potential over the next 3 to 5 years. This is known as 2 bites of the apple. If you haven't heard of it before, if you've talked to private equity, you might have heard of it before. But that's the number one reason why it exists, is to align incentives between the management team and the backer, if you will, that's not running the business, the owner. Other real good benefits of this structure is, for the portion that you keep on the table and it's basically a reinvestment in stock. That portion gets tax deferred, right? The capital gains tax gets deferred until you actually sell that portion of the equity down the road. So that's a plus. One of the interesting things about having equity as well is, like you kind of hinted at, is if you are really enthusiastic about the business and you find the right partner, the company can grow organically, maybe faster than you are growing now, but also with a private equity buyer, for example, that's backing you. They are experts in M&A. That's what they do for a living. And so you would have like a on-demand M&A expertise specialist that can help you do growth through acquisitions, that maybe you didn't have access to that and that expertise before. So you get access to all these resources that you didn't have before through a private equity owner, for example. And the result of rolling as much equity as you can, or reinvesting, if you will, into the future business, is that on the back end, depending on how much the company grows in the next 3 to 5 years, your liquidity event on the second piece could be larger, meaningfully larger than the initial cash at close. This is very common with a second bite of the apple in a company that grows a lot faster than it did before it sold to private equity. So, it's not an easy question, but sometimes it's not a choice. Sometimes private equity requires you to have skin in the game. That's another word for it, to have the interests aligned. So, but if you do have a choice, here are some questions you have to ask yourself on how much you want to roll. First of all, are you staying on, or are you going to transition out quickly? If you transition out quickly, there's really little to no reason to capture or have much skin in the game or much equity, because you're not going to have as much influence in controlling the outcome after you initially sell. So that's what business owners say a lot to us is, they don't want to lose control. They don't want to have a lot of skin in the game if they don't have control over what's happening at the company. So, if you're staying on and you're running it for the full time that private equity owns it, then it's in your best interest, if you are really enthusiastic about the future growth of the company, that you own as much as possible. And as a result, you can participate in, as much as possible on the future upside on the second exit, when the private equity group exits in 3 to 5 years, or probably more like 5 years on average. The other thing is, you got to look at the buyer themselves, okay, and understand the quality of the investor. Also, any concerns, like, for example, how well capitalized are they? And the one way to look at that is, for private equity at least, is, do they have a big fund where they can just tap into capital as they need for future growth? Like, for example, help you to source or invest in future M&A opportunities for the company, as an example. So before we switch to the next slide, I just wanted to really point out a clear example of where an equity role really can work. So we worked on a deal that was $75 million IT services digital transformation firm, was doing 14 EBITDA, growing 20% a year. The CEO owned 100%. He wanted to sell the business, but he ran a process on his own with his CFO, and we helped with that. And so we got a bunch of offers to the table. The bottom line is it's sold for 110 million, which was about 8 times EBITDA. The business owner was very enthusiastic and bullish about the future growth of the company. So he decided to not retire, to stay on and keep running the company. He sold enough so that post-transaction, he owned 49% of the company. The private equity group owned 51. But here's the beat of it that most people don't know, and this is the most important part. When private equity finances a deal, they use their own equity, but they also use debt. For a very clean company like this, they raised 4 times of EBITDA for debt. So they got about, I think the debt number was 61 million out of 110 was debt. And because of that, the CEO only had to give up, well, I guess the way to say it is he could take off the table 20 million more than he would otherwise if they didn't use debt. So that's one piece. The other piece is because he kept 49%, what happened is they grew a lot. They did one huge acquisition. And then like 3 years later, a strategic company called Cognizant approached them. They weren't in an auction process. They said, hey, we want to buy the company. They bought it for 550 3.5 years later. The total exit value for the owner's reinvestment, which was the 35 million that he actually rolled, that he didn't take off the table initially, turned into 270 million in 3 years.
Amazing.
So that's 235 million above what he would have gotten if he just sold 100% all at once, 110 million, 235 million extra.
Right.
So that is one example of how the 2 bites of an apple can work, and how an equity roll can really, really be super lucrative if it's a solid company with good growth potential.
Yeah, and oftentimes, Eddie, we do see our clients kind of excited about the equity roll portion, right? If it's within reason, and they are excited about the buyer partnership, right? And that's the beauty of having the strategic relationships, whether it's financial or strategic buyer, but having synergies with that buyer is critical. Could be huge, right? The upside's monumental.
Absolutely.
Yeah, that's great. Very good. Thanks, Eddie. All right. Coming back to a few other kind of elements in structure that we noted earlier. Seller's notes and holdbacks, a little less sexy than what Eddie just talked about, but really the core concept here is these are mechanisms for buyer protection. As a seller, you can negotiate terms to protect yourself, but these are kind of all points of deals. Seller's notes, right? It's essentially function as a financing when buyers want to preserve cash or bridge valuation gaps in the deal. You need to understand the rates and the terms, buyer collateral, credit worthiness, because they're essentially they're the financer of the deal, and you're the financer of the deal, and the buyer is going to pay you over time. And so these things need to be obviously very clear, and you have to be very comfortable with the credit worthiness of the buyer going forward. And usually you would be subordinated to senior lenders. So potential higher default risk there as well. But it is a nice kind of mechanism sometimes where the seller can capture additional return if they're comfortable with that scenario. And the buyer can, maybe drive valuation a little bit higher based on that. So again, highly negotiable at times. And we don't see this as a huge percentage of most structure or deals, but it's something to consider. The holdback scenario is a little bit different, right? Holdbacks are very typical. Usually it lands around 10%, but between 5 and 15% of the purchase price will be held by the buyer for 12 to 24 months to protect against indemnity claims, essentially. So, that is something where there could be some situations where the seller has some outstanding things to consider. It could be maybe HR related or something like that. It could be, hey, we have unpaid overtime for some employees or something of that nature that needs to be kind of flushed out over time. And so the buyer will withhold in an escrow account a certain amount of money of the deal to be paid out if everything happens as they said it would happen, right? And so most of the time we see these holdbacks come through. Sometimes there might be a haircut or two, but rarely do we see it completely lost. I think if you're a seller, you probably come to the table in your mind thinking, well, I'm just never going to see that money. That's not always the case. But you can minimize risk in a few ways. You can ask a push for rep and warranty insurance to reduce escrow requirements. That's essentially insurance that if any future claims by the buyer are made, there's an insurance policy to cover that instead of your money, which is in the escrow. So it's not, it's not taken out of your escrow or holdback. That's a possibility. And there's one thing else: you can start using standalone baskets to limit exposure. So there could be a basket for legal, there could be a basket for HR, there could be a basket for something else, for example. And so if something isn't met and the buyer does send over a claim at the end of the term, then maybe just that basket is exposed versus taking down your entire holdback or escrow account. So just some things to consider again in these scenarios. Again, the more structure, probably the more flexibility in that deal that could have an advantage for you or not. But all things, of course, consider when you get into the situation like this. Not every buyer is going to offer these specific mechanisms, but something to be prepared for sure. And we'll go back to Eddie over around one of the most important things in deal psychology. Eddie.
Yeah, thanks, Jeff. We've already kind of highlighted a bunch of the factors that go into deal psychology. It's important to come into a deal and when you start talking to buyers to have your expectations managed, because it may feel quite onerous how they approach it, whether it's a financial buyer or a strategic buyer. It's going to feel very intrusive, etc. But all this deal structure we're talking about, at the end of the day, what it is just a risk management tool for the buyers. It's also a way for buyers to use less of their own capital to buy a company. That's the game, okay? You can call it financial engineering, but it actually is proven to work well it's like a win-win when it's done right. So, we talked about the earnouts, we talked about the equity rolls, right? Those are going to be very common depending on the buyer, but what's really going to be most common with a strategic buyer is an earnout versus an equity roll. Because with a strategic buyer, you're going to be ideally selling all of the company, but to get the full payout, the company has to hit some thresholds or some goals over the next couple of years after you initially sell to get the full payout. So that is, as you can see, a risk management tool, right? It's also an opportunity for them to try to pay less than they initially offered with an earnout, right? So again, it's a risk management tool. Private equity or buyers are in the business of making money and maximizing value and maximizing margins. So return on investment as well. So that is the game. So you can kind of read into the buyer motivation, but that is the motivation. They either want to use less of their own capital to buy your company, or they want to mitigate their risk. The cleaner the company, the less structure they might offer. But the hairier the company, the more, mediocre parts of the business, the riskier parts of the business, they might ask for more structure. So, try not to take it personal and try not to think, what the heck are they trying to do here? It's just very common. Understand where they're coming from. Now, as we talked about, as the seller, you can turn this to your advantage. So, if you are really long for the business and feel like there's a lot of upside potential if we just buy like one or two companies with this partner, or if they can help us accelerate growth faster, then maybe I should take less off the table now and agree to or ask for more equity roll up front so it can capture more upside on the back end when the private equity group or the buyer sells their full stake. So that's one thing to think about. The structure also allows for the seller, for example, the CEO, if they want to start transitioning out to a slower pace of work, or maybe use it as a transition plan over the next 5 years to basically retire after 5 years, then that could dictate what type of structure you'd prefer as well. So sometimes what happens is A person that's, going 110 miles an hour every day, 110% is burnt out and they want to slow down. They become a chairperson or a more strategic role, at a minimum, a board seat, right? And so they're working part-time with the active management team, but they have some skin in the game as a chairman or chairwoman, but not as much as they would have, say, as if they were actually running the company day-to-day as CEO, if that makes sense. So, putting a bow on it, come in mentally prepared. All cash is not an option with either buyers in most cases these days, whether it's strategic or financial, as we discussed. It's important for you to know a couple things coming into the conversations, even before you get to market and start trying to sell the company. Identify your personal goals for the transaction. Are you looking to maximize cash at close? If you do, what's your minimum number? How flexible are you? What structure are you open to? Which are you not? Are you allergic to earnouts, but you're okay with equity rolls, or vice versa? These are all the things you have to know. You have to do kind of an inventory of yourself to really understand what you can live with, what you can't. Back to you guys.
Thanks, Eddie. Yeah, and so wrapping this up, and to build on kind of what you just said, you want to have a plan, right? Personally and with the business pre-sale. So position the business in advance, position yourself in advance to reduce just market risk in general and how the market or buyers perceive you and the company, right? To Eddie's point, personally understand where you want to be. There's a difference between gross enterprise value and net proceeds, right? So kind of have a plan that way financially, and understand what kind of risk you're willing to take versus the reward. Again, there's certainty to these scenarios. It's not just about valuation. To Eddie's point about cash at close and other things that make you more comfortable, but don't be afraid of deal structure, right? It's a good idea to try to create some leverage for yourself, and that requires flexibility, having an open mind, and of course finding the right partner to do the deal with. That is critical, because if that is in case the fact, then everyone gets more comfortable and confident in not just the deal outcome, but the future. A lot of this stuff is negotiable, right? As investment bankers, we are usually at the forefront of these conversations and are helping the sellers and buyers kind of come to a middle ground. But when we're representing the sell side, again, not being unrealistic, but try to get as much as we possibly can, right, to satisfy the client. But terms can hurt a deal or unlock millions, to Eddie's example earlier about that two bite of the apple scenario, right? So everything is negotiable in these scenarios. It's very rare that we get an LOI, for example, or an offer, and those terms stick, right? There's always some push and pull on both sides of the table. Number 5, really important, understand what your buyer values most. And so in that process, you have to understand who these buyers are, what they want to do with the business, and how that impacts you and the deal. And I think there's, as investment bankers, we do a lot of this work, but encourage our clients to understand too who they might be getting in bed with going forward. So what is that buyer value, and use that as leverage when you're trying to maximize value for yourself through the deal process. And leading up to the transactional event, it could be months or a year or so, but understand the different types of deal scenarios that we've discussed today, right? Understand structure and pre-model those structures and scenarios with your banker, right? And consider what each one means. If you go into that deal process in a prepared manner where you understand expectations and understand what the market might throw at you, it's going to get less personal, right? And to Eddie's point about deal psychology, it's just going to be less of an impact. So you can see this from an objective perspective and be comfortable with what you're trying to do. And so have a plan, pre-model those scenarios. Again, the deal-making process in our world is very much an artistic science, and there's a lot that can be engineered, but the more you're prepared, I think the better the outcome. And so that's what we're trying to help you with today. So I think, Tim, we can open it up for Q&A if there's anything, and happy to help people.
We went a little over by
5
minutes, 6 minutes. So we're going to open it up for a few questions. If anyone has any questions, feel free to drop them in the chat. While that's happening, got a question for Eddie, maybe just a clarification. Is the equity role primarily a tool of private equity, or does it also occur with strategics?
It can occur with strategic, but it's pretty uncommon because strategics are usually going to buy out the entire company. And usually the way that the strategics manage their risk is the earnouts, as Jeff described. So in theory, if let's say in year 1 or 2 after they buy it, if one of those 2 years the company doesn't hit the target for that year, the thresholds, the P&L thresholds, they just paid less for the company, right? Effectively. But yeah, it's very common. In fact, it's almost like standard with private equity. So keep
Okay.
that in mind. It's an exception if private equity doesn't do it. It's a rare exception.
Another question here regarding the reps and warranties insurance. Is this required at a certain dollar amount and not so much so at a lower amount? For example, if we're talking a 20, 50, $100 million deal, is it always standard issue that there will be some kind of rep and warranty insurance?
Well, yeah, I think that the larger and more significant material that escrow or holdback is, that's when that rep and warranty, that's essentially how you would, treat it. So if it's $100 million deal and the buyer wants 10% holdback, $10 million is a lot of money, especially if
Hmm.
it's part of your cash at close scenario, right? Where that's an extension of it. So if you're getting 60 million, but 10 of that is in a holdback, then yeah, I mean, that to me is something to consider. If again, if the buyer and seller agree to it, it could really help minimize risk for that seller.
Who's paying for it?
Who's paying the premium?
Hmm.
It could be both buy side or sell side. It just depends on the situation.